The market for BigBear.ai Holdings Inc. is currently closed on this Monday, April 27, 2026. The last recorded closing price for BBAI was $3.70, which occurred at the end of the trading session on Friday, April 24, 2026 at 4 p.m. EDT. During that final session of the week, the stock experienced a slight intraday dip of 0.8%, shedding approximately 3 cents from its previous value. While many investors are staring at that $3.70 figure and wondering if the floor is finally in, the reality underneath the surface suggests a massive disconnect between retail enthusiasm and the cold hard data of institutional positioning. Most people look at a stock like this and see a cheap entry into the intelligence sector, but the actual tension here lies in the fact that while the stock has retreated over 36% since the start of the year, major players like Vanguard and UBS have been quietly increasing their stakes. This creates a curiosity loop. Why is the smart money buying the dip while the price action remains so persistently sluggish? The expectation is that because BigBear.ai operates in the white-hot sector of machine learning and predictive analytics, it should be moving in lockstep with the giants. The reality is that BigBear.ai is a specialized defense contractor first and a tech play second, meaning its cycles are dictated by government budgets and long-term contract deployments rather than the viral trends that drive a typical online investment. When you look at the recent movement of BBAI, the volume tells a story of exhaustion. We saw about 21.8 million shares change hands in the last session, which is actually below the average daily volume of nearly 30 million. This suggests that the aggressive selling pressure we saw earlier in the year might be tapering off, but the buyers aren't exactly rushing the gates yet. If you are using a Fidelity trading platform or the SoFi Active Investing interface, you've probably noticed that the stock is currently pinned below its key moving averages. Specifically, it's trading well under its 50-day moving average of $3.79 and its 200-day moving average of $5.36. For those of you who track Nvidia stock or Tesla stock, you know that being this far below the 200-day line usually indicates a long-term bearish trend that requires a massive catalyst to break. That catalyst might be coming on May 5, 2026, when the company is scheduled to report its first quarter results. The expectation is another period of unprofitability, but the reality that will move the needle is their revenue guidance. If they can show that their recent acquisitions are starting to contribute to the top line, we could see a rapid repricing. The institutional activity is where the narrative really shifts. Despite the price drop, M&T Bank Corp recently acquired over 1 million shares, and entities like State Street and Geode Capital have been padding their portfolios. This is a classic case of institutional accumulation during retail panic. When you browse through investing sites or check your individual brokerage account, you often see the sell ratings from firms like Weiss Ratings, which recently reiterated a sell-G grade. This creates a fascinating environment for self-investing. You have the analysts telling you to run for the hills because of negative net margins, while the largest asset managers in the world are adding millions of shares to their Fidelity ETFs and Schwab Intelligent portfolios. It forces a rethink of the entire bear case. Is the company truly failing, or is it just undergoing the painful transition from a SPAC-era startup to a mature defense prime? If we look at the daily swings, BBAI has been a volatile beast with a beta of 3.47. To put that in perspective for those who use the Robinhood app or Interactive Brokers trading tools, that means this stock is nearly 3.5 times as volatile as the broader market. A 1% move in the S&P 500 often translates to a 3.5% swing for BBAI. This is why it's a favorite for those engaged in online investing who have a high risk tolerance. However, that volatility has been mostly to the downside lately. We saw the stock touch a high of $3.82 last Friday before settling back to $3.70. This failure to hold intraday gains is a sign that the market is still skeptical of the company's ability to turn a profit. The reality is that BigBear.ai beat earnings expectations last quarter, reporting a loss of only 1 cent per share against the 5 cents expected, but the market punished them because revenue was down 37% year over year. Investors no longer care about beat and raise on the bottom line if the top line is shrinking. Comment below how many shares of BigBear.ai you currently hold, and whether you think the defense sector's adoption of AI is moving too slowly for these smaller companies to survive. Now let's step back and look at what BigBear.ai actually does to understand why this tension exists. They aren't building chatbots, they are building mission-ready analytics for national security and global supply chains. Their business model relies on large, multi-year government contracts. This is a double-edged sword. On one hand, once you're in with the Department of Defense, the revenue is incredibly sticky. On the other hand, the sales cycles are brutal. This isn't like selling a subscription on a Fidelity mobile app where the user clicks a button and the revenue starts flowing. This involves years of testing, security clearances, and navigating the labyrinth of federal procurement. This is why their revenue can look lumpy and disappointing on a quarterly basis, even if the long-term outlook is healthy. They recently settled their 2029 convertible notes and finished acquisitions of companies like Ask Sage and CargoSeer.
These moves were designed to diversify their revenue away from just the military and into the commercial trade and trade sectors. The expectation was that these acquisitions would immediately stabilize the ship. The reality is that integrating these businesses takes time and costs money, which explains the negative net margin of 230% that has many users on the Robinhood trading platform feeling nervous. But look at the debt-to-equity ratio, which sits at a very manageable 0.16. This is not a company on the verge of bankruptcy, despite what the sell ratings might imply. They have a current ratio of 1.78, meaning they have enough liquid assets to cover their short-term liabilities nearly twice over. For an intelligent portfolio or someone using Fidelity Wealth Management services, these balance sheet metrics are often more important than a single quarter's revenue dip. They have the runway to wait for their technology to become a standard part of the national security infrastructure. Looking ahead, the future of BigBear.ai rests on two possible scenarios. In the first scenario, the May 5th earnings report reveals that the $135 million to $165 million revenue guidance for 2026 is actually conservative. If they announce new major contract wins, especially in the commercial sector, the stock could easily gap up toward the analyst price targets of $5 to $5.50. This would represent a nearly 50% upside from current levels. In the second scenario, the revenue continues to contract as government spending remains tied up in bureaucratic red tape. In that case, the stock could test its 52-week low of $2.66. The risk here is that the market loses patience with the AI growth story and starts valuing BigBear.ai as a struggling legacy consultant rather than a high-tech innovator. For those of you using SoFi Invest or checking your Robinhood investments, the key level to watch is $4. We've seen significant resistance at this level throughout April. If the stock can break and hold above $4 on high volume, it signals that the institutional accumulation has finally exhausted the retail selling pressure. Conversely, if we break below the recent support of $3.14 seen in late March, it could trigger a wave of algorithmic selling that would be difficult to stop. The macro pressure can't be ignored. High interest rates have historically punished small-cap, unprofitable tech companies because their future cash flows are worth less in today's dollars. If the Federal Reserve continues to signal a higher-for-longer stance, BigBear.ai will face an uphill battle regardless of its fundamental performance. The contrast between expectation and reality is most evident in how the public perceives the AI sector versus how BigBear.ai operates within it. Most people think AI means a parabolic move like we've seen with Apple stock or Nvidia stock, but the reality is that BigBear.ai is in the deployment phase, not the hype phase. They are the ones doing the unglamorous work of making the data usable for a general in a command center or a logistics manager at a shipping port. That kind of work doesn't always make for a flashing press release, but it builds a foundation for a business that can last decades. Whether you are using interactive brokers' fees as a reason to trade frequently, or you are looking for investment help for a long-term hold, you have to decide which side of the tension you believe in, the shrinking revenue of the past year or the growing institutional interest and expanding commercial footprint. To summarize the central insights we've covered, the expectation is that BigBear.ai is a struggling small cap that has lost its way since its debut. The reality is a company that has cleaned up its balance sheet, settled its debt, and is currently being accumulated by some of the largest financial institutions in the world. The live closing price of $3.70 reflects a market that is waiting for proof of life in the revenue column. While the volatility remains high and the technicals look weak, the fundamental story of defense integration remains intact. We are seeing a classic battle between short-term technical indicators and long-term institutional conviction. As we head toward the May 5th earnings report, the tension between these two forces will likely reach a breaking point. Whether you are managing your own Fidelity IRAs or just getting started with Robinhood fractional shares, keep a close eye on that $4 resistance level. The upcoming earnings call will be the moment of truth where management must finally align the market's reality with the high expectations they set at the beginning of the year. The depth of authority in this analysis comes from looking past the daily price fluctuations and focusing on the structural changes within the company's debt and its shareholder base. BigBear.ai is no longer just a speculative play. It is a battleground stock where the winners will be those who correctly identify when the lumpy revenue cycle finally turns back to growth. Maintain a disciplined approach, watch the institutional filings, and remember that in the world of defense tech, patience is often the most valuable asset in your Fidelity brokerage or SoFi trading platform. We have a company that is fundamentally different than it was a year ago, yet the price is lower. That is the ultimate tension that will define the next 6 months for BBAI investors. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.